Well, hello, this is Jim Musgrave with Research Financial Strategies, and welcome to the weekly market report for October the 3rd, 2013. So obviously the big story of the week is the government shutdown and the gridlock in Washington. But before I get to that, I'm just going to do a quick review and kind of tell you how we got here. Then I'm going to go over our strategy on what we see kind of moving forward. So if we look at the S&P 500, we are still in positive trend. Okay, so that's a good sign. We did see a pullback here in June. The market's hit an all-time high here in July. Again, we've seen a lot of uncertainty with the Fed tapering, the mess in Syria, as well as obviously the latest debt ceiling and continued resolution stalemate that we see in Washington. So the market did peak very briefly at just under 1730 and now has retreated to about 1678. That's about a 3% drop off its all-time highs. And again, our philosophy is to put stops at a negative 5% off the trailing high on non-leveraged positions. So one thing that we're looking at very closely is when to potentially exit if we continue to see deterioration in the markets. This red line right here is basically a support level at 1650, but actually a 5% pullback off the highs of 1629 is right around 1640. And if I take you to the chart of the S&P 500 on the point and figure chart, again a 5% pullback is right around here at 1640. So 1640, 1650, that's where you need to really look at your positions hard and determine if you're going to wait this thing out or if you're going to sit on the sidelines until things start coming back around. So that's a brief summary of where the market is at this point. I did want to share with you another thing in terms of the overall performance review. And so we break things down into different asset classes, and still U.S. domestic equities has outperformed everything. Overall 25% year to date is the average. Actually, the S&P 500 is the worst performing asset class in the U.S. domestic equities. We tend to buy RSP, which is the equal weighted S&P 500 in our accounts, and you can see it has outperformed SPY by roughly 4 points. But also we have seen a switch in the arm wrestling match of relative strength from mid-cap, which is represented by IJH, with small cap with IJR. So right now we find overall small cap is the dominant asset class within U.S. domestic equities. So that's something that we certainly own in our portfolios at this moment. We own both RSP as well as IJR. Now international is starting to kind of pick up a little bit, but it's still a distant second. And so we are underweighted in international. And we've been underweighted in fixed income for some time. Again, in my last report, I talked about the spike in the yield of the 10-year Treasury back in May. And so again, as yields increases, bonds drop, and you can see that the bonds have dropped considerably year to date, down. I guess if you look at the Vanguard Total Bond Index, it's down almost 4%. Again, commodities are still really struggling, as well as currencies, and cash is actually positive, about 3.8 on average. So that's a summary of the markets there. Now, going back to the government shutdown and the debt ceiling. So what's going to happen? Well, this is a report that shows you some history of what's happened in past government shutdowns. Now, this is the last one that happened. It lasted for 21 days from December 16, 1995 to January the 5th, 1996. And you can see that that government shutdown did not have a huge effect on the markets at that time. And if you go back to multiple government shutdowns going back to 1976, you can see that the markets really haven't reacted a whole lot. And that's actually a good situation considering that's where we are right now. Now, kind of going back to things, what does the government shutdown and the debt ceiling debate mean for the markets and your money? Well, again, as we know that the markets do not like uncertainty, and we've certainly been getting a lot of uncertainty in the last couple of months. Again, again, I mentioned Syria, I mentioned the threatening of tapering of the Fed. And again, we're really in this stalemate that we're locking horns with Republicans and Democrats and what's going on with this government shutdown. And we're just very, very concerned that both sides have really kind of dug in their heels, and more time that goes by. The difference between this situation and past government shutdowns is that, again, I just mentioned the this complete gridlock in Washington. And remember, if the federal government can't pay its bills, and again, it's estimated to reach its debt ceiling in just in a couple weeks on the 17th, again, they don't have money to pay for Social Security or Medicare and all these other services that we're relying on. And so the United States is a huge economic force in the world and a default currency. And so the thought of the United States government defaulting on our government treasuries and our bonds would send shockwaves throughout the entire world. And again, both the Republicans and Democrats realize this. And so hopefully that'll be enough motivation for them to start coming up with some sort of compromise. The other thing which we're really concerned about is the Fed tapering. And again, I go back to my chart right here, and again, remember back in June, this is when Bernanke was talking to Congress, and just even talk about the Fed cutting back on its $85 billion a month bond buying is enough to get the markets very nervous. And we saw this back here in June, and again, we saw this again here in August, and to everyone's surprise, the Fed met on September the 18th and decided, against everybody's prediction, not to start tapering. And that's a good and bad thing. It's good that they're going to continue to have easy money, and the stock market will continue to do fairly well, assuming that we get past this debt ceiling debate. On the other hand, the reason why they did not start the tapering was because they felt that the economy wasn't quite as strong as they initially thought, and also in addition to the this upcoming federal deficit debate that was going on. So the Fed has kind of held off on buying, or on their bond buying, and so I don't see the Fed tapering or raising interest rates anytime real soon. But when you know that they will, that could lead to some bumps in the road in terms of the market. So the only silver lining to this federal shutdown and the debt ceiling is that it's happening here in October, and everybody is predicting that they're going to come up with some sort of compromise and actually fund the government and extend the debt ceiling. And hopefully we can get this past us so we can go into the holidays and have a decent holiday season with consumers buying goods and services and the economy staying strong. So I think if we can get past that, we're going to have a relatively decent fourth quarter. So that's my recap for this week. Again, you got to hang tight, look at your positions. Again, we have exit points at 5% off the highs, but you need to look at each position and see where your exit points are going to be, and if you're going to wait this out, or if you're going to get on the sidelines if things completely start to deteriorate. But again, we have a sell-side discipline. Our number one objective is to manage your money and to protect your principal and be in the positions that are going to make money when the market continues to climb. And again, this is very volatile. It could turn around in a minute and start going the right direction. So right now we still remain about 70% invested, have about a 30% position in cash in our 100% equity portfolio, and but we're watching this stuff on a daily basis, and we are ready to pull the trigger when if things start to deteriorate anymore. So again, if you have any questions about your accounts, want me to review your accounts that I don't manage, give me a call, send me an email. I'll be happy to talk to you. And again, I want to thank you for taking time to watch you and listen to my weekly market call. Again, Jim Musgrave, Research Financial Advisors. We'll catch you next time.